Welcome and thank you for joining us today. We have Wes Shannon back today, and he's going to talk about required minimum distributions. If you have any questions, you can post them in the chat, and we'll get to them periodically throughout the program. So let me start by introducing Wes. After working decades in the insurance and financial services industry, Wes Shannon left insurance to do full-time financial planning and investment advising. He is the founder of SJK Financial Planning and specializes in working with business owners. Over the years, he has worked on with many small business people, especially helping them retire, or as Wes will say, setting up the end game for their business. He has a bachelor's of business administration from UNT, majoring in financial planning, and is a certified financial planning professional. He enjoys the outdoors, participating in backpacking, hunting, fishing, canoeing, and camping, and he likes to cook, garden, and read. He has a passion for old movies and is a Turner Classic Movie fan. So Wes, I'm going to turn it over to you, and then I'll come back at the end after your presentation, and we'll finish up with questions.
Thank you, Jennifer. Appreciate that. Let me put the screen share on, put the slides up here, and here we go. Can everyone see the slide presentation? Jennifer, does that look like it's correct?
Yep, looks good.
Okay, good. So we're going to talk about required minimum distributions and how to manage them. I'll stop every 15, 20 minutes and look at any questions we have and try to answer some of those. Again, thank you for that gracious introduction. This is a little background of me. I grew up here in Fort Worth and I went to Southwest High School and UNT. And by the way, SJK are the initials of my kids. So that I had trouble getting a name approved by the Secretary of State. So I said, well, they don't know my children, so I'll do that. So it's kind of a fun thing. Why do we have RMDs at all? Well, and forgive me, but these numbers are actually about 4 years old. But at that time, we had $25 trillion in this country in retirement plan money that has not been taxed yet. So there's about $6 trillion plus that the government can tax these retirement plan funds. I mean, that would be, if over a 20-something year period, that'd be over $220 billion a year in additional revenue. So the reason we have an RMD is so the IRS can collect taxes on money that has never been taxed. And it was always deferred. So that's why they do it. It's required to get people to pull the money out and eventually have to pay the taxes on those retirement funds. There's a penalty. What it is it's an annual withdrawal from your retirement accounts. And when you withdraw it, it's taxed as ordinary income. That's why they're doing it. As the previous slide said, there's a lot of tax money together, but there's a penalty. If you don't take out your required minimum distribution each year, you can be penalized for 50% additional taxes for the amount, 50% of the amount you should have taken out. So if you were supposed to take out $20,000, you could have a $10,000 penalty for failure to do so. So it's something you just can't let it slide. You got to take care of it. When do you have to do it? Well, you don't have to do it. They've changed the law now, which I was rather surprised. They made it a little longer. It used to be 70 and a half. Many of you may remember that. But now the law is age 72. So in the calendar year you turn 72 is when you start taking out your required minimum distribution. Or if you're in like a 401k at work and you're still working and you don't quit working until after 72, then it starts as soon as you retire. There is an exception to that if you own the business, but we won't spend a lot of time going over exceptions. The rule of thumb, though, is age 72, you have to start taking it out. This does not apply to Roth. Roth IRAs do not have a required minimum distribution because you paid the tax on that money before you deposited it into the Roth IRA. So that's an advantage of a Roth, is that you don't have this. And then naturally, at the death of the owner of a retirement account, the RMDs begin at that time. We'll go over those rules. So how do you do this? How do you figure it out? First of all, you take the balance of the account on December 31st of the previous year. So for our 2022 RMDs, we're going to look at what was the balance on December 31, 2021. And then we take a factor from the IRS, what's called the Uniform Lifetime Table, and we divide the balance on December 31st by the number from the table. I'll give you an example. A person age 72, if they had 216,000 in an IRA, at the end of the year, the number on the table would be 27.4. So they would divide that by 27.4 and it'd be $7,883.21. For a lot of my clients, I just rounded up to 7,900. Remember, it's a minimum distribution. You're always allowed to take out more if you want to, but this is at least the minimum you must take out. We do use a different table if your spouse is more than 10 years younger, and the spouse is the beneficiary of the IRA. But that, again, is one of those exceptions that we'll look at. Here's what the Uniform Lifetime Table looks like. These are the current ones as of 2022. The IRS has changed these. Take a note that where this thing ends at age 115 or older, it used to end at 100. And this is kind of reinforcing what I've been saying for a while, is that there is a large industrial medical complex out there trying to keep us alive much longer than we thought we'd ever live. So, it's real. I have clients all the time say, oh, well, my parents were dead by the time they were in their late 80s. I probably won't live past that. Actually, you're probably going to live 20 years beyond the average date of death of your parents. So that is, that scares me. My parents are still alive in their 80s, and my grandparents, my last one just died recently in late 90s. I had 3 of my 4 grandparents almost lived to 100. So I sit there and I go, boy, I have to take care of myself because I'm going to be around a long time. But the IRS has recognized that people are living longer, and they've adjusted this table to take it out for many more years. But as you can see, another thing to take note here, and we'll talk about it in the next slide, is look at the numbers. 72 is 27.4, then it's 26.5, then 25.5. As you get older, the factor gets smaller, thus it means a larger amount you have to take out. So each year as you age, the RMD increases. And so the way that you can, if you're sitting there saying, oh, I don't want these, a lot of people end up saying, well, I don't want the RMD right now because I don't want the taxation. Well, the best way to avoid it is to reduce your balance at the end of the year so that your RMD is less the next year. And there's different strategies we'll talk about how you can reduce that favorably. But just remember that as you get older, the required minimum distribution is going to increase. Now, here's a couple problems with it. There's no capital gains. Everything that's coming out of an IRA or retirement plan is going to be taxed as ordinary income, as if you earned it. Capital gains get a much lower tax bracket, tax rate. It's 0, then 15, and then 20 is the highest it goes. Whereas the personal income tax rate goes up right now to 37.5. And then there's some Medicare tax on top of that if you're that tax bracket. So the bad side about an RMD is it's going to be counted as income. And that's going to be bad because it could cause your modified adjusted income to go up, thus making more of your Social Security taxable. I know that sounds kind of weird, but RMD has forced many people to go from where only half of their Social Security was taxed to now 80% of it's taxed. Also, it can push you into a higher tax bracket. The RMD could be an amount high enough to move you up to the next bracket. And another problem with the RMD is that it requires you have to liquidate the holdings inside your retirement account. So this is especially problematic for people. A few years ago, there was a trend where people would go out and buy real estate with their IRA, and they'd buy, let's say, a rental house in Colorado, and they buy it in the IRA, and that was their IRA investment. Well, that's fine for a while, but then when RMDs come, and let's say you have to take out $20,000 this year, if it's all in the house, where's the $20,000 coming from? You have to sell the house, because you can't very well just sell a portion of the house. So it can cause you, or if you have stocks, it'll cause you to sell those stocks for the RMD, and it may be a bad time to sell. It may be a low market. So RMDs are problematic in these areas. It can cause you to pay more in taxes. It can cause more of your Social Security to get taxed, and it can cause you to sell your investments in your retirement accounts before you really planned on doing it. So the big questions you've got to ask yourself is, one, do you need the money to live on? And a lot of people do. That the RMDs are fine. A lot of people are like, hey, I've got to spend it anyway. I might as well. Then there are some people that are well off enough with other sources of income or other funds where they say, I don't need it to live on. So then they want to reinvest the money. They say, I don't want to spend it. I just want to reinvest it. So we'll look at those options. And there's a lot of people, that say, well, I just going to leave it to my kids or to my heirs, or I want to give it to charity. And all of these can be addressed and can affect your RMDs. Like I said, the question is, you have to ask yourself, is that what I really, what is it that I'm looking to do? Let me take a look real quick at some of the chat questions. You see the next slide notes. Okay, well, let's change that. See if this, I don't know how to change that. Yes, you can ask questions here. Someone says, I can hear, but that's an old question. So okay, yeah, I'll see if I can affect the way you're looking at. Let's see. No, that didn't change it. I lost it. All right, let's see if we can go back to the screen. There we go. I'll give you the full screen. All right. Like I said, if anybody has any questions, they can write them into the chat room. All right. So we talked about this already, about strategies and what to do. We talked about the questions you need to have to ask yourself. Well, here's some strategies, 6 strategies on how to control or manage your RMDs. First of all, you want to figure out which accounts you take it from. We're going to look at Roth conversions. We're going to look at working beyond 72. We'll take a look at what's called a QLAC, Qualified Longevity Annuity Contract. And then a very popular thing is number 5, Qualified Charitable Distribution. And then last, we'll look at how you could use these funds to fund a grandchild's or niece or nephew's college savings. First of all, RMDs are calculated individually for each account that each retirement account that you have. So if you've got 3 different IRAs, it'll be calculated for each one. Or if you have 2 IRAs and a 401k, it'll be calculated for each one. You can take, the IRS will allow you to take all the RMD from just one of the 3 accounts, like in that scenario I mentioned. And that's helpful, again, if going back to, if you have real estate in one of them, maybe you just do your withdrawals for RMDs out of one that doesn't have real estate. But you can take it from each one, or you can take it from one only out of all different ones. 401ks and other retirement accounts that are in the employer retirement deal, they have to come from each individual account. So again, if you have 2 IRAs and 1 401k, you'll have to take one from the 401k, and you'll have to take one for the 2 remaining IRAs. Roth conversions. First thing that people ask me is, well, can I just take that RMD and convert it to a Roth? And the answer is no, you can't. The IRS says you got to take it and pay the taxes on it, and then you can convert additional amounts to the Roth. So the way they view it is the RMD is going to be income to you. And if you're not working, then you can't contribute to a Roth. So you just take the income from the RMD, pay the taxes on it, and then if you want to, you convert additional funds from the IRA to the Roth. Now understand, every time you convert, it's a taxable event. So if you have $50,000 in an IRA and you want to put 10 of it into your Roth, you're going to pay taxes on the 10,000. Now, the IRS has changed the rules where a lot of IRA administrators can hold back the taxes. So let's use that example. You want to convert 10 over to your Roth, you can get your custodian for your IRA to send 7,000 to the Roth and 3,000 to the IRS as a payment. So you can withhold the payment if you want to in doing so. The beauty of this is now you've reduced your IRA from 50 to 40,000. So that's going to make your RMD next year a little less because you reduce that balance. So that's one of the real side effects of Roth conversion. Plus, you're paying the tax now, and you're locking in the taxes. You don't have to pay them again in the future in the Roth. So another problem with RMDs is if you just take the minimum each year, you notice how that, remember our factor, it gets bigger each year. Well, if taxes start going up, you'll pay more of it in taxes as time goes by. So doing the Roth conversion says, I'll pay the taxes now and I'm done with it. I won't have to do this anymore. I really prefer to do the Roth conversions before you get to 72. That makes it lowers the RMD by the time you're at 72. And usually that time period between when a person quits working and when they get to 72, their income's pretty low, and it's a good time to do Roth conversions because we're at a low tax bracket. So the main thing is you do need to coordinate your tax brackets with your tax planner or your financial advisor on those Roth conversions. You don't want to convert so much that it bumps you from a 22 to a 25% tax bracket. Also, Roths are good ways to leave the money to the kids. Basically, the philosophy is you're paying the taxes now while you're working. A Roth is, you pay it while you're working, and then you don't have to pay it when you're retired, and you don't have the RMDs at that time. A lot of people are working beyond age 72. This only applies to non-IRA accounts. So I have a client who's 76 years old. He's still working. He has a large IRA. We have to still do RMDs from his IRA, but his 401k where he works, he doesn't have to do a required minimum distribution because he's still working. Now, the exception to this is if he had been an owner of the business or a 5% owner or greater, he would have to take RMDs from the 401k also. But you can defer the amounts in the retirement accounts at work by just continuing to work past 72. Also, if you have a rollover IRA from a previous plan, this is an argument to roll it into your new 401k so that you can avoid the RMDs until you quit working. All right, QLACs. There's a lot of publicity about these. The way this works is you're buying an annuity that is going to defer the annuitization to some future date. Now, the IRS has put a limit that you can't do more than 25% of what you've got in your IRA can be put into this QLAC. And the maximum is $135,000. So they do put a limit on it. But when you do that, you can defer the income from the annuity as far out as age 85. So during that period of time, the money that you put into this QLAC is not counted in the calculation for your RMD. So if you had $270,000 in an IRA and you put, well, excuse me, in that case, it wouldn't work because you're limited to 25%. Let's go back and let's say you had $400,000 in an IRA and you put 100 of it into a QLAC, then only 300,000 is going into the calculation for their RMD. So you reduced your RMD. But the downside is that you don't start getting the money from the QLAC until that date that you've set out in the future for the deferral. Let's say it is 85. At that point, it starts paying you a lifetime annuity, which means you'll never run out of money. You'll always get a monthly check or an annual check for the rest of your life. But if you don't live very long, you won't get back the money you put into it. If you put that $100,000 in there, defer it to age 85, and then you die at age 82, you're not going to get back the 100,000 you put into it. So that's where I say it's a 50-50 chance of making a positive return. Some annuities out there offer a return of principal death benefit guarantee. It says, okay, in that scenario, you put 100 in, you start at age 85, you die at age 87, you've only taken 20,000 out. The contract says we'll pay your heirs 80,000, the difference of your original amount minus what you put into it. But you often have to pay additional fees for that benefit guarantee. It's real important to really get a professional to help you look at these annuity contracts. They're got a lot of moving parts. There's a lot of hidden fees. It can be helpful, especially for people that have a small amount of money. And if they're still working, it can defer that RMD on their IRA and then give them a lifetime income that they know they'll never outlive. So that's an advantage. Now, you may not get as competitive market returns in an annuity as you would in the stock market, but overall, it'll do as well as most of your bond holdings. So it's not a bad thing. It's just kind of part of the overall plan a person needs to look at having. Qualified, this is the most popular that I see retirees doing. What it allows you to do is, instead of taking the RMD, if you have like in my original example, the 72-year-old with 216,000 had to take out 7,900. Instead of taking the 7,900 as income and then writing a check to their church for 7,000, which may or may not get deducted because of the high standard deduction, they could call their IRA trustee and say, will you send that 7,900 or 5,000 of it directly to my church? And if they do it that way, the IRS says you met your distribution. You're not going to pay tax on that gift. So it's a full tax deduction. And then anything additional over the gift that you take out will be, for the RMD. Let's say if you sent 5,000 and you take 2,900 for your RMD, and that's all you pay taxes on, and you gave your church 5,000. It could be any qualified nonprofit organization. It could be the Cancer Society. It could be the Botanical Gardens. It could be, any religious organization. I ask clients, what are you passionate about? Who do you want to help? And it's a great way at age 72 and beyond to get the maximum deduction for your charitable contributions and reduce your RMDs in the future, because it reduces your balance. So excellent. I bet nearly half of my clients that are on required minimum distributions fund their churches or their charity of their choice using this qualified charitable distribution. Again, this goes back to those questions. If you need this to live on, then it's not very practical to do this. But if you don't need the RMD to live on, this is a really good way to help others and to reduce your taxes. And then finally, the last thing we're talking about is you could take your RMD and turn around and put it into a 529 college savings plan for a grandchild or a niece or a nephew. You don't really get any tax benefits from this because you're still going to pay taxes on the RMD, but it is a nice way to pass the money on to your heirs. And grandparent 529s have been enhanced under the law that allows you to become more favorable. Some of that money in the college savings plan can be used for the child's private school education before college. I believe it's $10,000 a year. It can be used for parochial school or private schools. It doesn't get counted against the child for their financial aid application because it's owned by the grandparents until they receive it. So a lot of times I tell grandparents, let the child borrow some money and then just pay off the note. So there's a lot of different things you can do with a college savings plan. There are some restrictions. If the kid doesn't go to college, you can move it to another child, another grandchild or niece or nephew, or that child could take it and let it grow and use it for their children, your great grandchildren. But there are some limitations, and it has to be used for qualified education expenses. Let's take a quick look here at any questions. No, we're good. Well, I'll take that as that we're covering it pretty well then. Go back to the slideshow. All right. If you want or need to spend the RMD, then take it at the very beginning of the year, and that way you have it available for your expenses, or ask the trustee of your IRA to set you up on a monthly or quarterly payment from the IRA. I have a lot of clients that are retired. They like to do it monthly. Makes them feel like they still have a paycheck and they can manage it better. But then some people say, well, I'll just take it at the beginning of the year and be done with it, and I'll just manage it from my savings on my own. Either one's an option. If you do decide you want to reinvest your RMD, so you've paid tax on this money, and now you want to invest it somewhere, municipal bonds or municipal bond funds can be a good source of tax-free investment. So you've paid the taxes on it now, and then you put it in the municipal bond fund where it's not tax, the interest is tax-free, and so you don't pay any more taxes on it. Another option is just to invest it in exchange traded funds or a tax-wise mutual fund, because just like it'll be treated like stocks. If you bought stocks with it, you don't have to pay ordinary income on it until if you own it for 12 months or longer. Then it converts to a capital gain. So I explain to people, you pay the tax on the RMD, you turn around and you bought ETFs or stocks, and you're not going to pay the taxes again. You're not going to pay the growth on that money, the taxes on it. You'll never pay the taxes on the original RMD again. You've already done that. But any growth, you won't pay taxes on it until you sell it. And at that time, if you've had it 12 months or longer, it'll be a long-term capital gain. It'll be taxed at a lower rate. If you're in a low 20% tax bracket, the tax rate on the long-term capital gains is 0. So it could be very advantageous. So also, last thing here, you can make your RMDs in securities. In other words, let's say you have, let's go back to that example at the beginning of the $216,000 in an IRA. If it's all in stocks, let's say a good portion of it is in Lockheed Martin stock, you could just transfer out 5 or 6, let's see, it'd probably be about 15 shares of Lockheed Martin would be equal to that $7,900. You could just transfer the shares out into your brokerage account, and you'd pay the tax on the $7,900, but that would be your basis in the stock going forward. So you don't have to always take cash. You don't have to sell. There are, we talked about earlier about one of the problems is you have to sell your assets when it may not be a good time to sell. If you are not going to spend it, then go ahead and just pull out the actual shares out to meet your RMD. Okay, so it goes back again to, those questions. You're going to live on it, you're going to reinvest it, you want to give it to your heirs, you want to give it to charity. Let's talk a little bit about RMDs at death. A qualified beneficiary in general should be an identifiable individual. In other words, it has to, the beneficiary has to be a named person. If your son is Sam, it needs to be Sam Jones or whatever your last name is. If it's your spouse, it needs to be their name, and it needs to be stated my spouse. All the IRA and retirement account funds have beneficiary forms, and it guides you on that, but it needs to be an identifiable person. You just can't say to all my children. That's not going to work. Or if you do it to a trust, which you can, the beneficiaries, though, have to be identifiable people. It has to be irrevocable and valid under state law. I've dealt with a few RMD beneficiaries that are trust, and it's a little awkward, but it can be a good tool for certain circumstances. We'll talk about that. First of all, if your spouse is a beneficiary, which in retirement plans at work, the law requires it has to be the spouse unless the spouse signs a waiver. IRAs, that's not the case, but a lot of the IRA custodians will ask for the spouse's signature if it's not going to be the spouse. But when the spouse gets it, he or she's got two choices. One, they can keep the account in the name of the deceased person. So if I were to die and my wife kept the IRA in my name, it would say individual retirement account in the name of Robert Wesley Shannon, deceased. And the RMDs would be based on my age and at the time each year going forward. So if I died at age 70, in 2 years, RMDs would have to start, even though I'm dead. We'd have to use my date of birth to calculate the age 72 for the survivor's age, and we'd use that column on that table. The second option, which is the most common, is if the spouse inherits it, just roll it into the spouse's name, and then it starts using the spouse's date of birth. In my case, my lovely wife, Marcia, is 3 years younger than I am. So if I were 73 and taking RMD and I died, she could inherit it, roll it over into her name. At age 70, she'd have 2 more years before she'd have to start taking out RMDs. So those are the two main options available for a spouse. If it's not a spouse, if it's your kids or a friend or a niece or nephew, they have two choices. They can take it as a lump sum, or they can take it any manner they want to, as long as it's all taken out in 10 years. So the IRS this is a big change in the law from 3 years ago. This is saying it will all come out and get taxed within 10 years. Now, again, that 10 years is the maximum amount of deferral. If they need the money or they want to use it for something, they can take it all in over 2 years or 1 year. The problem is if you take it as a lump sum, it all gets counted. Let's say if it's a $200,000 IRA and someone takes all $200,000, then that year on their tax return, it shows they made $200,000 plus whatever they made from their job, and it'll put them in a higher tax bracket. So, but 10 years is as long as it can defer under the current law. There is an exception to every rule. An exception is an eligible designated beneficiary. And they have the option of taking the distributions instead over 10 years over their life expectancy using a table from the IRS. And the people that are eligible for this are spouses, which we talked about. She could put in her name, take her table in her lifetime. Minor children, disabled individuals, per the rules of the IRS rules of who's disabled, and chronically ill individuals, and individuals that are not more than 10 years younger than the IRA owner. So if you live to your best friend who's only a couple years younger than you are, they're eligible to be a designated beneficiary. The rules on this, though, change once you cease to be one of these categories. So, for example, minority children, if it's a 10-year-old who's a beneficiary, it can be taken out on life tables over their lifetime, small amounts because they're young. But once they hit 18, then it has to do it within 10 years of 18 because they're no longer a minor. So once you lose this eligible designation, then it has to be within 10 years. So if you're a chronically ill person and you recover and you get well, then the IRS says, okay, now the 10-year rule applies to you. You got to get it out within 10 years. Or if you're disabled and all of a sudden you you're not disabled per the IRS rules, then all of a sudden the 10-year timetable starts. So these are the exceptions to the general rule of thumb is it's 10 years for non-spouses, and spouses can put it into their name and do it over their lifetime. If it's left to an estate, if you die before age 72 and you didn't put a beneficiary, then it's going to go to your estate. And in that situation, it has to be dispersed within 5 years from the date of death. If you die after 72, then it can be made on the deceased person's life expectancy. Go back and use that table for their age, but you can't do it longer than 17 years, at which time you got to take it all out. Now, the problem on this and the 5 years, that means you got to leave the estate open for that long. You got to file an estate tax return. You got to go to the judge. It's all part of the probate process, and the longer probate goes on, the more expensive it gets. So that's not deferring this to 5 and 17 years to an estate generally doesn't make sense. The problem with leaving to an estate is that it is subject to probate and estate income tax tables, which are pretty high. And then they're also subject to all the claims against an estate. So if a person had a lot amount of debts and they left their IRA to their estate, that money will go towards those debts. If they left them to their nephew, the nephew gets it directly and is not responsible for the debts. So there's not a lot of good reason to leave an IRA to an estate. It's really highly recommended to name a beneficiary. And that kind of concludes the, I got my contact information here. If you want to contact Jennifer or me direct, I'll send you a copy of these slides. And I'll be happy to answer any questions we have right now. Doesn't look like we have any. Looking at the chat. All right. Seems like we got done a little faster than I anticipated.
Quite all right. Yeah, it doesn't look like we have any questions.
Good.
So I just want to say thank you for your time.
Sure.
And we did record this presentation, so if you'd like to rewatch it, it will be posted to our YouTube account in probably the next week or so. Okay. And if you just go to our YouTube page and turn on notifications, then you'll be good to go. So thank you, Wes, very much. Thanks for everyone attending, and you guys have a great afternoon.
All right. Goodbye. Thank you.
Bye-bye.